Hey, it's Jim, and this is level 2 of the CFA program, the topic on ethics and professional standards, and the reading on guidance for standards 1 through 7. We're up to standard 5, investment analysis, recommendation, and action. This happens to be my favorite standard, mostly because it accurately reflects the definition of a financial analyst. If you look this up, a financial analyst is probably any individual who values a security or an asset and then makes a sound judgment about the appropriateness of that security or that asset for specific clients. So you look at parts A, B, and C, you can probably see why this is my favorite standard, because especially part A, diligence and reasonable basis, that reflects almost everything that we've done in the CFA program. And then as a professor, I love communicating with clients and prospective clients. And of course, I love communicating with just about anybody else. And then the Institute clearly emphasizes the importance of records retention. Once again, there are the LOSs that we've had for all 7 of these. So let's go ahead and start right in on diligence and reasonable basis. So notice some of the bolded words: diligence, independence, right? We don't want to have any kind of a bias. Thoroughness, that sounds an awful lot like due diligence that we've talked about for a long, long time. Reasonable and adequate basis. Notice there's a comma after that, supported by appropriate research and investigation. Now, of course, we'll address this here in just a few minutes, but what is appropriate research? Well, I tell my students this all the time, that you're going to have a supervisor that gives you an assignment, and you're going to have to figure it out. And that's what the Institute means by appropriate research and investigation, figuring it out using all different resources that are available to us, not least of which, of course, are Wall Street Journal, Moody's, Bloomberg terminals, prices of credit default swaps, et cetera, et cetera. Let's go ahead and start with a good question here. We're a research analyst following Company X. Let's see, all the information that John has accumulated and documented suggests the outlook is poor. All right, so the stock should be rated a weak hold. Now, during lunch, however, so this is an indication that something bad is going to happen, right? So the first sentence up there, that's all reasonable. During lunch, however, what does John do? He overhears a financial analyst. I don't even know what that means, overhearing. As I'm getting older, I'm losing my hearing, so I can't overhear almost anything, but I'm not sure what that means. But let's see, another firm who he respects offers opinions. Oh, so that's probably a clever way to get us thinking that this might be okay. Whom he respects offers an opinion that conflict with the forecasts and expectations. So this dude returns to his office and releases a strong buy recommendation. All right, so John Willier, what has he done? Well, clearly, if you put C down there, was in full compliance with the standards, then you ought to go back and start at the very beginning of the handout and reread all that stuff. So what is the violation? Is it because he did not have a reasonable basis and adequate basis, right? Or is it because he failed to distinguish between facts and opinions? Well, clearly A and B are reasonable answers for different kinds of points inside of the question stem. But here we have, no reasonable basis. All we did is say, oh boy, this dude over here, I respect his or her opinion, so I'm just going to change my opinion. Maybe that person is smarter than I am. Maybe I missed something. But, of course, we're being trained to say things to ourselves. You know what? We've done all this work, so we need to have confidence in our work. So the distinguishing between fact and opinion, that's probably a good answer for another question stem, but not this one here. All right, so what does this mean, this due diligence, right? Cover all relevant issues. Let's go back to Eugene Fama in 1970 when he developed this efficient markets hypothesis. What did Eugene tell us? He said, look, the price of any financial security ought to reflect all relevant information. Now, whatever that relevant information means, well, this is what lots and lots of really smart professors have done. And of course, the CFA Institute has adopted this. That relevant information is in 2 pieces. You have the relevant macro information, which includes things like inflation and interest rates. And then you have the micro relevant information, which includes things like for a corporation, it's branding, it's dividends, it's mergers, all that kind of stuff. So think about it. What we're responsible as good financial analysts is to process all of that relevant information. Now, that doesn't mean that every time we have an assignment from our supervisor or some kind of a task provided to us by the client that we need to spend thousands of hours on it. For example, if I came to you and said something like, hey, you know what? I would like for you to look at my portfolio of 20 treasury securities and tell me about their level of default risk and their level of interest rate risk. Well, you would not have to do 1,000 hours of research because you would know that these things are pretty much default risk free, and you would be able to look at the duration and the convexity of each one of those treasury securities, and you'd be able to offer, some kind of an opinion. You could do this in probably a couple of hours. You wouldn't need thousands of hours. So that's a really good question. Depends on the product or the service offered. Now, what are the resources? Financial statements, company reports, Bloomberg, Wall Street Journal, third-party research, et cetera, et cetera. All right, so remember that each one of these parts inside of a standard has some highlights. So here is the guidance using secondary or third-party research. I've said this before, but I think it's worth repeating. So you have somebody over there, whether it's an individual, whether it's a firm, whether it's a government, whatever it is over there, if we need to hire those people to get their opinion, then we need to make certain that those people over there, that they act exactly like we do here, right? Now, one of the interesting parts of this section in the handbook is that what the Institute recommends is that we take a look at the performance of that third party over there, and we need to get as much of detailed historical performance as possible. So there's the arrow point, says something like, hey, 5 years is better than 2 years. 10 years is better than 7 years, et cetera, et cetera. Yeah. Now, of course, what we want to make certain that we do is that we should encourage firms to adopt policies that are similar to our policies, emphasize periodic review, make certain that we do lots of monitoring, make sure that there's lots of disclosure, make sure there's independence, make sure there's no bias, make sure if that third party is using a model, maybe they have a proprietary model and they don't really want to tell us about that. They're interesting ideas and how this model works, but clearly they need to share something with us. What is diligence and reasonable basis? Well, diligence, I've said this before, this is just plain old hard work. Reasonable basis, then, that is a different kind of a layer. And what we're trying to say is something like, look, we've done all this work. And what is a reasonable effort in terms of, and I think I did this on that last recording, breadth, and depth. We don't want to do breadth so that we go all the way out here, and we don't want to do depth till we do all the way to the core of the earth, right? But the idea is that the more information that we have and the more knowledge that we have, that we can make these decisions. Remember in one of those previous standards, we had this suitability. And so this is a great combination question here where we perform our due diligence. So we have this reasonable basis, and then what is suitable for these particular clients here. Now look down at the bottom there, examples of attributes to consider while forming a basis, quality of the assets. This goes directly back to our favorite economists, or at least among our favorites, Franco Modigliani and Merton Miller, all the way back to 1958, where they developed that capital structure irrelevance proposition. But what they decided was that, hey, you know what? Don't worry about capital structure. Focus on the ability of the company to generate lots and lots of sustainable cash flows. So remember that in a question stem, you're probably not going to read the term quality of assets, but you might read something like, hey, they have this much in cash flows, and it's sustainable, or it's expected to be sustainable for the next 3 to 5 year period, something like that. Operating and financial history of the company. So this has everything to do with all that stuff that we studied in financial statement analysis. And then this is what I was saying earlier, these macroeconomic conditions. There's that one piece of the two-piece puzzle of relevant information. We love models, right? Quantitatively oriented research. This is why the Institute makes us comprehend and understand and apply regression analysis, correlation analysis, time series analysis, optimization, asset allocation, all that stuff. So we need to understand the model itself and then the inputs that are used inside of that model. Now, of course, what goes side by side with this is our understanding. The Institute wants us to understand the limitations of those models. We can't just throw in a bunch of inputs and say, all right, here's the output, and we're going to put all of our eggs into that output basket. And we might make an assumption that sounds like, oh, we think the yield curve is going to change by a parallel shift upward or a parallel shift downward. So if our model doesn't include the possibility of twists and turns and all sorts of different curvatures in the yield curve, well, then our model, it might in fact be useless. All right, how do we thoroughly test these models? Well, we did all that stuff back in our quantitative methods conversation. And what we need to make certain is that we take a look at history, right? And then we do some sampling, and we do in sampling and out of sampling. We do all that stuff. And then we need to make sure, and we'll talk about this in just a few minutes, that we communicate all of this to our clients. And we say, look, here's a model. We really like our model. It's not a perfect model, but what it does is it gives us a reasonable basis to recommend shares of stock or a credit default swap or whatever that security being valued is. All right, selecting external advisors and sub-advisors. This is super similar to third-party stuff. We probably need some kind of standardized criteria. And so, of course, the industry has best practices. So what code of ethics, compliance, procedures, quality of their published return information, make certain that they're not publishing, the average return, make certain it's a geometric or an internal rate of return. Investment process adheres to the stated strategy. That makes perfect sense. Group research and decision making. This is this concept of dissociation, where we have to say something like, and we talked about this in a previous recording, where we were not happy with either one of our colleagues or somebody at another firm or a client's behavior. And so we just say, time out, we're out. But that doesn't imply that everybody inside of a group has to form a 100% consensus. As long as the member or candidate is confident about the process, they need not to decline being identified with that report. Now, let me go ahead and pause here and say this is a really, really good exam question in there to link the behavioral issues of finance with this group thinking, right? You remember, there's the herd mentality. Do we want to go along with the herd? Do we want to be a contrarian? All that kind of good stuff could be lumped into a question. So make sure that you pay attention to the question stem. All right, so you should probably be able to guess what the recommendation is here. Have these policies, develop guidelines, measurable criteria. This is so important when evaluating the performance of an analyst or a third party or groupthink or our entire firm or whatever it is. We want to make sure that we can measure it, right? We can say something like, oh, yeah, Jim, he's a great advisor over there. I just have a sense that he's a great advisor. But you need to support that with, an internal rate of return, or, hey, Jim was able to identify a merger candidate, or, boy, he was really spot on in that prediction of a firm that declared bankruptcy within 2 days of his investment recommendation. Yeah, there we go. So let's go ahead and work at an example here. Junior fixed income analyst, Fed interest rate expectations over the next 2 quarters. Boy, wow. If Samuelson could accurately predict Fed behavior over the next 2 quarters, every time that he puts together a process, he would be pretty high in demand. All right, so here's the excerpt. With the economic slowdown caused by COVID, we expect that Fed will hold Fed funds rate steady at 0.25% over the next 2 quarters. All right, the majority of the investment committee does not agree with Samuelson's conclusion. The committee overwhelmingly believes there will be a strong bounce back in economic activity. All right, so here we have a conflict between Calvin and the committee. And this is a dramatic change, right? The committee believes that the Fed is going to increase the benchmark by, just their minimum amount over the next 2 quarters. Let's see. He believes that there is no reasonable and adequate basis for the committee's conclusions, but proceeds to leave his name on the report. Has Samuelson violated this standard? All right, notice we have 2 yeses and a no. Yes, because his report is supposed to reflect his views and conclusions. Well, I mean, that's okay if he's the only one writing this report. But remember, this is a group report. No, because the firm's internal policies require a consensus opinion. Well, we don't know anything in that question stem about the firm's internal policies. Maybe we can think about that. Maybe we know, excuse me, that there is a requirement for a consensus opinion. The third part there, yes, because he fails to dissociate from the report when he believes that there is no reasonable basis. All right, look back up at the standard, reasonable basis up there. So that's probably the correct answer. There we go. Because he fails to dissociate because he believes that there is no reasonable basis. So what does that mean? That means that he's thinking that these other people are maybe herd mentality, maybe they're exhibiting some kind of a bias. Remember, we have these emotional biases here, and we have these cognitive errors up here. So we don't know a whole lot about these kinds of things in the question stem, but C seems like the best answer there. All right, how about the second part, communication? And here's this is what I said in the introduction. Here's the new part of this reading for this year and this year's learning module, that we need to be very careful that, of course, the Institute wants us to disclose, disclose. But if we are facing the clients on a regular basis, we need to make sure that we disclose not just our costs, but their costs as well, and those fees. All right, so the first thing, this makes sense, right? Disclose the nature of the services provided, information about the cost. So I added a little bit extra to the cost, but we have a couple slides here that do this. Why are we doing this? To protect the client interests. I mean, this is so obvious. I'm not sure I even need to say this. Of course, there are going to be issues where we put the client in a portfolio and the portfolio doesn't perform as well as we would like, and then we have these fees in there. And so the client's going to come to us and say, why am I paying you all these fees? And we get out the policy statement and we say, oh my gosh, here they are. They're right there. It doesn't say you have to pay me these fees even if I stink, or even if that boutique firm stinks. It just says you have to pay these. All right, so that's important communication. All right, what kind of services do we provide? Are you going to write down fixed income? Yes. Equity securities? Yes. Alternative investment? Yes. So do the nature and scope of all these. Are you going to write about transplanting the azalea bush? Probably not. What are the requirements down in the bottom? It requires comprehensive disclosure. So this is what I was saying just a few moments ago. Disclose, disclose, disclose. Now, here are the costs, and make sure that you are aware that we need to disclose our costs as well as those third-party or the affiliate costs. Associate costs to clients and prospective clients. There's a little mini case inside of this learning module where, and let's see if I can get this right. What we've decided to do is go from using an average, like a weekly balance or a monthly balance, I can't remember. You'll see this when you look at the learning module, to using either beginning of year or end of year balances. I can't remember exactly what it is. And so you just need to make sure that you disclose that we have changed from one fee structure to a different fee structure. So there we go. Disclose services and associated costs, all expected charges if we're changing. Some other issues out there. Maybe this will show up as perhaps just one question. Notice in that first bullet point, look at the word down there under the second bullet point, indented, must update the disclosure. So this is really critical. Sounds like a great exam question where our firm lists all these fees and costs, and then sometimes during the year, maybe it's December 15th, and we change these for the last 15 or 16 days of the year. You need to do it right on that day. You need to update those disclosures. The scope, look at the example there. There we go. Affiliates. Didn't I just say that affiliates, related entities, or third parties? That's the new part of this reading. So make sure that you highlight this in your notes. A good question might be something like, hey, here's a list of all of ours. And because Jim's cousin Joe over there, he's a related party, you don't need to worry too much about those. You don't need to worry too much about his fees. So that would be a violation. Best practice of the manner, make sure that you pick up the phone and call, send an email. I don't know anything about social media, as you know. I don't know. Can you tweak these things? Probably not. Do you want to put it on Snapchat? Probably not. I don't know anything. Maybe they're appropriate. I'm going to guess that they're just not. Anything that's on social media, I'm going to be not in favor of for just whatever reason that I can come up with. But look at the best practice down there. Make sure you put it in written form. And if you email it, you just keep a record of when that is. Yeah, so what's our requirement here? Basic format, general principles, promptly disclose material affect these processes. Now, of course, we're going to have a client who calls us every single day and says, boy, I'm looking at these reports, I'm looking at all the disclosures, but somewhere in between disclosure 627 and 628, I don't really see anything in there. So if that client says, what is 627 Part B? Well, then you need to make sure that you make that available to that particular client and everybody else out there. Yeah, what is a research report? When I was going through the program, over 2 decades ago, this is just when internet just became, gosh, I don't even remember if I even knew what the word internet was in the early 2000. But nowadays, I don't know what all this means. Can you Snapchat a report like I was saying a few minutes ago? Yeah, research report is not just the old annual report that was issued by these companies back in the old days. Now, remember what I said earlier, we're trying to pick a winner inside of the Kentucky Derby. We're trying to pick undervalued stocks. We're trying to pick bonds that are going to be upgraded. We're trying to pick alternative investments that have low correlations but have higher expected returns. Well, we need to disclose all of those kinds of concepts. I mean, clearly we can talk about returns if we want to, but the focus here are what kind of risks. So, of course, you want to mention things like standard deviation and beta. And that might mean absolutely nothing to some clients, but that doesn't mean that we're not required to disclose. Of course, a bond rating, that would be important. And then some limitations or restrictions that sound something like, you know what, this ratings agency, they rated these bonds before, but they made a mistake in 2008. So here's the rating now, and let's be aware that these ratings have some kind of a time lag. Maybe they're performed by somebody who's no longer with the ratings agency. Maybe the economy has changed in such a dramatic fashion that we're looking for some kind of a change. Look at this. The standard communication with clients and prospective clients. What I would love to say is let's just combine that communication, clients and prospective clients with a reasonable basis. The Institute, they don't ask us to do anything that is unreasonable. Yeah, some risks should be well explained. So this is what I was saying about beta and standard deviation and the Sharpe ratio and Jensen's alpha. But what you're probably going to do is disclose these in more broader fashion. So with credit risk, you'll probably talk about the bond rating. With country risk, you'll talk about exchange rate risk and political risk. If you have industry risk or market risk, you'll probably talk about beta, maybe value at risk, counterparty risk. Maybe you'll talk about third way risk. Remember, what did I say? Third way? I meant wrong way risk, counterparty risk. That's just essentially default risk. Yeah, understand the limitations. I just had a lecture in my investments class the other day. We went to Morningstar and we took a look at a mutual fund. We did the Janus 40 fund. So we went through all that stuff that's inside of there. And I said, all right, suppose that we clicked over here somewhere in Morningstar and we could come up with the Janus hedge fund. How different would this look? And so we went through, probably a 30-minute lecture about the difference between a hedge fund process and a regular old equity mutual fund process. So make sure that the client understands all of those limitations. And then look at that third one there. This is a really good exam question. So the question is, CFA Institute does this. Hey, here we are. We're disclosing we own some kind of a security. And if the interest rates move in this direction, which we think they're going to do, oh my gosh, then you'll make this much in profit and your P&L statement will look super de-duper, et cetera, et cetera. So yeah, make sure that you say, okay, if interest rates go up, one thing happens. If interest rates go down, then something completely different is going to happen. Something completely different. There's my Monty Python reference for the day. If you guys don't know who Monty Python is, go watch The Holy Grail as your homework assignment. All right, what else must we do? Well, there's that reasonable word. Again, I love that word. Judgment in identifying factors that are important. What are the factors that are important with transplanting an azalea bush? Well, whatever they are, dirt, shovel. What are the important factors for determining whether a company like Johnson & Johnson is undervalued or overvalued? Well, of course, all the macro information is important. GDP, interest rates. Industry information is important, and firm-specific information is important as well. So we need to make a reasonable judgment out there. The example that I give students all the time, I'll say something like dividends. Does that sound reasonable? Yep. Reasonable and relevant? Yep. Merger and acquisition activity, reasonable and relevant? Yes. Number of clouds in the sky? Of course not. So if you get a question where the Institute says number of clouds in the sky, mark that down as irrelevant. Yeah, of course, as well-trained analysts, it's up to us to decide which factors to include or exclude, but we're going to include those that are reasonable and we're going to exclude those. Now, if we omit something, we probably need to disclose how that omission is relevant to what's going on in the future. I mean, for example, you could have gotten away from, let's say, the year 2000 to the year 2000. What year was that? 21. You could have said something like, inflation is 2%. We expect it to be 2%. It is going to be 2%. It's just going to be 2%. So we're going to not focus inflation as one of our input factors or our risk factors because we think it's just going to stay at 2%. Let's find some other factor out there. Maybe it's default risk, maybe it's maturity risk. Whatever it is, we'll find that factor. Okay, what factors are important? But then, of course, inflation. What year was that? 2021. It was over 9% here in the United States. All of a sudden, that becomes relevant and important again. So my inflation example was probably not the greatest example, but things happen over time and factors change and their relative importance changes. And that's why we're going to spend tons of time on time series and regression analysis in level 2. I don't ever go out on a limb. I want to go out on limbs in guaranteeing questions on the CFA exam, but I don't ever guarantee. But I'm going to go ahead and say this is a super likely exam question. Make sure you distinguish between fact and opinion. You've probably read about this. Maybe you've heard this from other candidates. This is an important one. And the Institute is pretty clear when they put together these practice problems and the mock exams where opinion is an opinion. Like, I believe that interest rates are going to go up. Well, that sounds an awful lot like opinion rather than, hey, the rating on this bond is triple B. How do we communicate these opinions and facts? Well, if we have an opinion, that's okay. We can tell the client, hey, it's our opinion that we believe that interest rates are going to rise. And if our opinion changes, then we need to make certain that we tell them. Now look what we have in bold. Facts should be separated from statistical hypotheses. What I would do, my suggestion is for you as you're going through these problems, is to decide on, when you're reading this, which is fact and which is opinion, and then highlight the fact and say, okay, this is a fact, and then underline the opinion so that you can remember this as you're going through all the questions. All right, let's talk about Regis Partners here to end this section. Large cap European stocks, minimum market cap of $5 billion. Okay. The economic outlook, growth prospects diminished over the past year. All right, so we have this. We have a fund, and what we're worried about is the growth rate. So if the growth prospects have been reduced, then maybe we can't even call it a Euro large cap growth fund anymore. So to broaden this, we change to market cap of 2.5. All right, this is okay. Marketing and promotional material informs all current clients about the updated investment process, but does not feel the need to update any prospective clients of the firm. Oh my gosh, this is an explosion right inside of your brain. We liked everything. We liked everything till we got down to that update prospective clients. I mean, look at the standard. It says communication with clients and prospective clients. It doesn't say communication. It doesn't read. It doesn't read communication with clients. And sometimes when you feel like it, or if the mood hits me, I'm going to inform my prospective clients. So there you go. That's clearly the correct answer. All right. How about record retention? This is a simple one here. Develop and maintain appropriate records based on everything that we've done, right? Investment analysis, recommendation, actions, everything that we've done. Let's start with a good question here. Working from home on weekends occasionally saves correspondence with clients and completed work on her home computer. Because of worsening market conditions, one of several employees released by the firm. While she's looking for a new job, she uses the files saved at home to request letters of recommendation from former clients. She also provides prospective clients with some reports as examples of her ability. Well, there's a couple things in there we probably don't like. Which of the following is most likely correct? Let me emphasize this. Make sure you circle the most likely and don't answer the least likely. All right, let's see. Violated the code because she did not receive permission. Yeah, we like that. We always want to get permission. Let's see. We did not violate because the files were created and saved on her own time and computer. Well, she's working from home on weekends. I don't know if that forgives us on our own time. That doesn't sound right to me. Violated because she is prohibited from saving files on her home computer. Well, I mean, if we're working from home, we need to use a computer, right? But we need to make sure that we maintain those records properly. So there we go. Permission from her former employee. We always need to ask permission. We've talked about this in several other recordings. So ask permission, and then remember to ask permission. All right, so what is the guidance here? What qualify as records? Anything that you wrote down, right? Personal notes, third-party reports, press releases, email correspondence. And of course, the Institute is not making us keep piles and piles of papers, so we can do this electronically. All right, so here are the highlights. New media records, right? Just because there's some form of information that we're not familiar with doesn't make it okay for us to eliminate those from record keeping, blogs, texts. I say this regularly. I don't know anything about social media. Instagram, TikTok, whatever those things are, we need to make sure we keep records of them. Records are the property of the firm, right? So this goes back to what we were saying in that example. Local requirements, look at the last bolded point. CFA Institute recommends maintaining records for at least 7 years. And then after 7 years, you probably ought to shred them. That makes perfect sense. All right, recommended procedures. Firm has responsibility. So this also links back to our previous recording on responsibilities of supervisors. So the supervisor, and this will go back to, we need a formal kind of guidelines to outline these procedures for maintaining good records. Archive research notes, electronic or hard copy, preservation. All right, so let's go ahead and end with a good one here. Head of quantitative research. Over 6 years, he has contributed and developed the firm's quantitatively driven strategies. Diligently documented the assumptions and reasoning behind his work. So that first paragraph, we love everything in there, right? He's resigned, plans to start a consulting firm. With the permission of the employer, he copies the records of his supporting documentation that he has previously worked on. All right, so is there a violation? Notice we have 1 yes and 2 no's. All right, because he is not permitted to make copies of any material. Well, he got permission, and that's the part B, right? He received permission because he maintained all documents related to the work. Well, no, he's probably supposed to do that. So there we go. He received permission. So what did I say just a moment ago? Ask permission, and then ask permission. So there we are with Standard 5. Next up is Standard 6, conflicts of interest. Boy, these are going to be loaded with obvious conflicts, potential conflicts, and then the appearance of conflicts, right? So we'll have a great time talking about Standard 6. But what I want you to do now, and you should be ready for this, I want you to take, how about just 8 minutes and read those 39 questions at the end of this, of the handbook. Hey, thanks for watching and good luck studying, and I'll see you soon.